Alright, what is up, boys and girls? Welcome back to another video, and also welcome back to another video explaining about Equation. This is a protocol that I have been talking about quite a lot recently on the channel. It's a team that I have actually been talking to personally a little bit, and basically I've been essentially promoting this platform as something that is a very, very interesting concept to me, and something that has been doing very, very well recently. It's had a very significant pump after having quite a decent correction recently, and I've had a lot of questions regarding the platform after I've been talking about it quite a lot, about how it's actually used, because obviously these kinds of things, DeFi protocols, can be quite complicated for most people. Obviously I've been in the crypto space for quite a long time now, so I understand these things quite well, but overall I would say that sometimes things can get a little bit confusing for people. So I think this is probably quite an informative and interesting video about how to actually trade perpetual contracts on Equation. It's a very, very interesting platform. It's done very, very well recently, and it is on Arbitrum, which I do think is going to have a very, very nice run this time around in the bull run. So I'm just going to go through this little slideshow that I've put together, basically to give you an indication of how these things work. I think it'll be quite useful. And if you want to use Equation, as always, you can go down in the description and sign up via the link. It's very, very simple to get started. And I think it's going to be very, very useful for people going forward who want to do leveraged farming and also leveraged trading in DeFi on crypto. So if you take a look at the slideshow, then you can see Equation, a new startup perpetual protocol in the Arbitrum ecosystem, has been operating stably for nearly 2 months. I've been checking this out pretty much since it started, because I think it's been very, very interesting, and I think going forward it's going to be very good as well. You can see the new BRMM model based on the liquidity pool balance rate mechanism. The total contract transaction volume has exceeded $20 billion. So we've already had a lot of people trading on this platform, a lot of people, and it's going to grow at an exponential rate in my opinion. As I said, Arbitrum, a very, very solid platform with a lot of TVL as well. I think a lot of people will probably come over and use this platform to trade on Arbitrum as it becomes more renowned. You can see recently Equation has also launched a zero trading fee event, which you can go and get involved in as well. You just need to bind your referral code, and basically you'll get zero trading fees, which is waived by the Equation team, which is pretty cool. So basically you can trade without fees for Bitcoin and Ethereum perpetual contracts with USDT, as you can see on these pairs. In addition, under the influence of position mining mechanism, you can also obtain additional EQU tokens, which is their token, as holding incentives. You can obviously see there are a lot of very nice incentives recently for using this platform, and I think you also get Equation tokens, which are going to increase a lot in price in my opinion as well. So you can see here a little explanation of what perpetual contracts are. It's a contract with no expiration date that anchors the contract price and spot price through the funding rate. Specifically, the market price on the Equation page is the price of the current contract. The index price is the current spot market price based on Chainlink. Obviously, we all know what Chainlink does. In daily contract transactions, including opening and closing positions, taking profits or stopping losses, transactions are conducted based on the current market price. To protect any investors from unnecessary losses in volatile markets, forced liquidation is based on index price rather than current market price. So you get slippage, essentially is what it's called, where the price between the index and the actual market price are different, and then you can get liquidated based on, you know, when there are significant amounts of volatility in the market. As you can see here, there's a nice example in this picture. You can see the index price is $41,815, but the actual price here, $41,826. So you can see there is a little bit of a deviation between these two prices, and this can actually make a huge difference when you're trading. You can see Equation uses a BRMM mechanism to calculate the balance rate of the liquidity pool, and based on the proportion of temporary positions held by liquidity providers, and uses the balance rate to calculate the premium rate of the contract price relative to the index price, therefore realizing the discovery function of the contract price. Basically, this means that when the index price, which is this price here, is known, the market price is determined by the balance rate of the liquidity pool. So when a trader opens or closes a position, it will cause the number of temporary positions held by the liquidity pool to change, affecting the market price change. So basically, you can see here, when the imbalance between the longs and the shorts intensifies, the inconsistency will be further aggravated. So something to keep in mind. I do think that Equation is very, very good. They're looking to basically help out people here by making things a lot more simple, and also making things a lot more safe for people. Obviously, it's very, very important when you're doing any kind of leverage trading to take the measure of the risk that you are taking. But you can see that there are some basically very, very interesting functions here that are definitely going to be things that you need to keep in mind. A perpetual contract is a contract with no expiration date. This is something that a lot of people don't understand. Obviously, a lot of people do trade futures as well, which do have expiration dates, and it's based on the spot price through the funding rate, which is something that people also don't keep in mind often. So moving on, proper use of take profit and stop loss functions. Obviously, if you've done some trading of your own, you will be aware of take profit and stop loss functions, but just in case you haven't, here's a rough overview of that. In contract trading, take profits and stop loss functions refer to functions that are automatically executed when the transaction reaches a certain point. So obviously, if you're looking to take profit at a certain level, the price comes up and hits that level, you will essentially be taken out of the position automatically with the profit at that level, and the stop loss is the same. If you open a trade a long position, for example, expecting the market to go up, and then all of a sudden the market starts going down, you put your stop loss, say 5% below your original position, and it goes down, it will automatically close that position, so that you essentially are not stuck in a trade that is continuing to the downside. It's very, very important that people use these, because you can obviously avoid taking unnecessary risks, and you can also you can basically take profits automatically in case you don't have the ability to just sit there and watch the trade and then take profit and close it manually. If you have a specific level in mind that you think that a trade might hit, you can obviously just put your take profit at that level and you'll be taken out of it. So it's obviously useful in, like I said, in examples when you can't just sit there and watch a trade and close it manually, or if you're not holding for the long term and you prefer just to get in and out quite quickly, take profits can be very, very useful in this regard as well. You can see typically on centralized exchanges, take profits and stop loss orders are automatically closed as the position is closed. However, in Equation, take profits and stop loss orders are recorded on the chain as independent orders and will not be closed when the position is closed, but will automatically resume effect the next time the position is opened. I think this is very, very interesting, and definitely something that is going to benefit people. You can see, to explain this in even more detail, this means that every time we use the take profit and stop loss function in Equation, we need to check whether there is a take profit or stop loss order on the chain after the position is closed that needs to be closed, or the trigger price adjusted. You can see here, you got your orders, you got your positions here, and you can see you've got your trigger prices. So just something, a slight nuance basically with Equation. I think all of these functions are very, very useful for people who are looking to do more advanced trading as well. You can see in this example here, you can cancel all your take profit and stop loss orders through the cancel all button on Equation. If there are unexecuted limit orders in the order, cancel all will also cancel those as well. So you can see here, you've got your orders here, position, stop loss, position, take profit, position, stop loss. These are, they say that they're expired here, but you can see obviously you have all your functionality. You can cancel them here if you wish to as well. You can see that cancel all button will obviously close those. They are recorded on chain separate from your actual orders, which I think is quite interesting. So Equation also gave a reminder for such orders that are temporarily invalid but may also be activated. So you can see here, you'll get a nice little pop-up that does tell you about, basically, if you're closing a position, you need to cancel your take profit stop loss orders, because they'll remain valid, because they are essentially counted as their own positions on the chain. So something to keep in mind when you are using the platform. Obviously this is a bit more advanced and in-depth than most platforms that people tend to use, but you can see here there are some very, very useful, and in my opinion very, very good for beneficial for traders, I should say, functions here that need to be considered, but obviously a bit more nuance and a bit more understanding needed before using the platform. You can see here, it is worth noting that take profit and stop loss does not perform perfectly in all situations. For example, when the market rises rapidly and then falls rapidly, or falls rapidly and then rises instantly, the take profit order may be triggered when the market price has just reached the target price. Still, during the execution process, execution will be stopped because of the trigger conditions cannot be met, and the order will be retained. So for example, if your order does not get filled because there is a lack of liquidity, or if the market moves so quickly that the price essentially doesn't stay at that level long enough for it to be executed, then the order may remain open, despite the fact that the price has technically crossed that threshold. So also something to keep in mind if there's crazy volatility in crypto, which there often is. So you can see here, take profit order until the next trigger is executed. During the execution process, execution will be stopped because the trigger conditions cannot be met, and the order will be retained, and then the take profit order will remain because it's its own separate position, as we explained before. So something else obviously very, very important to know. In addition, the following are also scenarios where the take profit and stop loss situations fail. Order execution lag, which is something this is a very high level concept, but some people will obviously encounter this. If the take profit and stop loss order held by Harry is preempted to be executed by his counterpart's contract order after reaching the trigger price, the market price changes and is no longer satisfied with the take profit or stop loss order trigger, and the execution will fail. So essentially, if the price moves past this level, or someone else takes the contract at that level, then the take profit or the stop loss may not trigger, which means that they will remain open until they are satisfied again at a later date if it comes back up to that price, etc. And the other thing that I mentioned here, insufficient liquidity, is the second point. The order size in the system needs to execute exceeds the market liquidity supply. So obviously, when you're in a market with buyers and sellers, if you're trying to buy, you need someone to sell at that level, and if there's no liquidity, you won't be able to buy at your order size. Say for example, you wanted to buy one Bitcoin at $40,000, and there's only someone's only willing to sell half a Bitcoin at that level. You'll only be able to buy half a Bitcoin until someone else comes along and fulfills the rest of the order. So something else to keep in mind: if you're trying to sell a massive position at a certain level, you may not be able to actually sell it because there may not be enough people basically giving the liquidity for you to do that. Something else very important to keep in mind. The third reason, the stop loss point and the forced liquidation point are too close. This can happen sometimes where essentially you will get liquidated, obviously because you're using leverage, so there is a point where the system will automatically liquidate you to protect itself from massive losses. Obviously, if the stop loss and the liquidation point are very, very close by, you may just end up being liquidated regardless of your stop loss, because you are so close to that point anyway that the system may liquidate you before then, especially considering this potential slippage in the market. And the fourth reason, insufficient position balance. When the system determines that the margin balance after stop loss may not be enough to pay the handling fee, it is determined that the execution of the stop loss order has failed. So sometimes you might not you may not get your stop loss hit because essentially you may not have enough margin to continue holding that position even after the stop loss is hit, for example. So something to keep in mind. There's a lot of nuances to this, but a lot of this, if you are a reasonably avid trader, you should have an understanding somewhat of what's going on with all this. And finally, something that the Equation team has been highlighting throughout this video, the last but not least, do not miss a zero fee trading event. Even though most perpetual dexes have all the advantages of decentralization, transaction costs are the most important for contract traders. No one wants to pay another gas fee 1 second before paying the handling fee. But imagine how it would be if you only had to pay 50 cents to complete a contract order of any amount. Through the author's personal experience, the cost of the perpetual contract trading on Equations include the gas fee when opening the position, plus the gas fee when closing the position, plus the order execution fee. But thanks to Arbitrum's low gas fees, the contract interaction fee in most cases is only 0.5 U. It's very, very low, what they're saying basically. And this means no matter how large a position you open in Bitcoin and Ethereum trading peaks before the end of January, you only need to pay the basic gas fee on Arbitrum, which is also very, very low. An Equation does not limit the trader's position size. You can maintain a minimum margin rate of 0.25%. So basically, you're allowed to do very, very big position sizes, and you only have to maintain a minimum margin of 0.25%, which is very, very good. You can see here, you can also earn a really, really crazy APR on a lot of position mining here. You can see if you put these, if you basically provide liquidity for these, you will be getting some crazy APRs here. You can see essentially getting well over 1 or 2% a day on these positions. So something that I'm definitely going to look at myself personally, which I've been overlooking. But overall, you can see the conclusion. The correct use of the perpetual contract trading arbitrage requires an in-depth understanding of the market and Equation product mechanisms. After all, there are essential differences between on-chain and off-chain products. Market fluctuations and risk management also need to be treated with caution. As I said at the start of the video, leverage trading is always very, very risky. This article can provide you with some help so that you can essentially trade better on Equation. So that is it for today, guys. I hope this helped. I will provide a link to this in the description so you can go back and read it for yourself, or just obviously rewatch the video. I think the team are really creating something quite special here, and it's going to be very interesting to see what happens next. As always, go down, sign up below using the link, get involved with Equation, because I do think it's going to be a very, very top quality platform, and I'll catch you in the next video. Cheers.